Thank you very much. Great, well, let's get going. So again, my name is Tony Davis, President Emeritus of the MIT Club of Great Britain. Welcome to everyone joining. Thank you for joining us. We are delighted to have Dave Butler, co-CEO of Dimensional Fund Advisors, here to have a fireside chat with us. So before we get going, just a couple of ground rules. You'll note that you're not able to unmute, so don't look for an unmute button. However, what we do want is to encourage you to use the Q&A function to ask questions at any stage during this evening's proceedings, not the chat box, but the Q&A function. And we look forward to answering as many questions as we can at the end of the session. So just to give an overview of this evening, we will have a fireside chat from Dimensional Fund Advisors, from Dimensional. DFA was founded by David Booth, who's still the executive chairman, and he is the University of Chicago Booth School of Business is named in his honor. DFA will, of course, tell us more about themselves. I was interested in a couple aspects, many, but in addition to the connection to the Booth School of Business, I felt that DFA's approach to investment and investment management was very analytical and intellectual, and there's some academic links, and their science, if you will, of inverted commas, has moved with the times, so somewhat MIT-esque, if you will. I'm sure I'll get corrected on that later on. And then Dave Butler, the co-CEO, who will be speaking with us this evening, attended University of California at Berkeley, got a degree in marketing and finance and an MBA. I hope you won't mind me saying he was a big college basketball star in the Basketball Hall of Honor and the Hall of Fame at Cal Athletics, and in fact was drafted by the Boston Celtics. So I think that's a very interesting background, both in terms of the firm and in terms of Dave's background. So as advertised, the fireside chat will be about what Dave has learned about leadership and in leadership in financial services and successful investing. And hopefully he'll also be able to draw on his success in competitive sports and how that has helped him in his career as well. So exciting evening, very interesting topic, and we really are delighted, honored, and privileged to have Dave join us this evening, and also the support from Dimensional for the event. So thank you very much for that. We are co-hosting and co-sponsoring the event with MASECO, a private wealth management firm. And I'd like to introduce Josh Matthews, co-founder and managing partner of MASECO, to say a few words about his firm and their relationship with Dimensional, and then we'll proceed on into the fireside chat. So thank you, Josh.
Thank you, Tony. Thanks so much. I'm delighted to be here tonight, and thank you all for hosting, for coming to this event. I'd like to start by telling you a little bit about my journey as an investor and how I ended up here with such a nice relationship with the folks at Dimensional Fund Advisors, known as DFA. As you go through the journey of investing, a lot of you have, I'm sure, invested your own assets or have been investors for a long time. I started my career with Solomon Smith Barney in New York City, and at the time we were it was the start of what we called fee-based management. And basically, we went from basically calling people and saying, let's buy this stock and sell that stock, to basically starting to run portfolios for people on a fee-based percentage of assets type of strategy. So I moved here in 2001, so I'm in London. And we continued for a number of years with at Citigroup. I started the US expat team at the time because there were a lot of Americans here that we were working with. We managed the stock option plans for companies like Honeywell and Pfizer and IBM. And anyways, there were massive tax law changes in 2008 for all the non-DOMs in the crowd. And at that time, anything that you had invested in before 2008 that wasn't going to be tax efficient afterwards because of the non-DOM tax laws, we decided that we needed to get a better strategy that was basically more on the tax management side as well as on the investment management side. So having historically done mostly investment management, we need to do something also on the tax management side. And this is where we decided it was time to start our own firm, MASECO, which we did in 2008. Just before that, I met one of the top guys at Dimensional Fund Advisors here in London. His name is Sam Adams, who's with the firm for many, many, many years. And as an American himself living here, we highlighted the fact that everything that he was invested in was no longer going to be tax efficient after this date. So we engaged with Sam. Dimensional Fund Advisor was a great partner in the sense that they got a lot of their funds to be UK reporting status, which is very important for Americans living here. So basically, you want to be tax efficient from a US and a UK perspective, as many of the Americans on the line will know tonight. And basically, Dimensional Fund Advisors was one of the first firms that we worked with to do that. Over the last 13 years, our relationship has grown significantly with them. We met over time, of course, David Butler, who's with us today, David Booth. There's a very strong academic focus with the firm. So we met some Nobel laureates such as Eugene Fama and Myron Scholes, as well as Roger Ibbotson from Yale and Ken French. And over the years, our clients have invested heavily, if you want to call it, in these what we call asset class funds that have done very, very, very well. We've had a very good experience, and they do exactly what they say on the tin. Anyways, I'll pass you over to Dimensional, but over the years, we really have gone to what's called an evidence-based approach to investing, which is what sometimes we call the science of investing, which has been incredibly heavily influenced by Dimensional, by Dave Butler and the team. So thank you so much, Dave, for agreeing to show up tonight. Thank you.
Okay. Well, Tony, should we begin?
Yes, so I wanted to say, I was just looking at my technology there. So onto the Fireside chat, and thank you very much to Dimensional. We've already introduced Dave Butler, and a Fireside chat that takes at least two to have a chat. So we're very delighted to have David Swanwick from Dimensional in London, who's head of client communications for the EMEA region and a vice president here in London, as the moderator or interlocutor with Dave Butler. So over to the two of you, and we're looking forward to hearing more. Thank you.
Well, thank you, Tony. And on behalf of Dave and I, we're just absolutely thrilled to be here. We'd like to thank you and all the members of the MIT Alumni Club of Great Britain for making this invitation possible, and also to our friends at MASECO. And Josh, thank you for the introduction and the background context. I think that really sets us up well to have this conversation with Dave. And over the little bit of time that we've got together, I think we're looking forward to Dave being able to pick your brains a little and share some stories and hear some wisdom about all of the topics that have been mentioned in the introduction. But maybe first things first, the best way to just really kick things off is to ask how you are and how things are in Texas, given this pandemic's affecting us all. What's the situation where you are?
Thanks, Dave. I appreciate that, and thank you, Tony and Josh, both for those kind remarks. Very humbled to be here. Very appreciative of the time to spend with you, and excited to chat a bit further about the firm and about capital markets in general. Here in Texas, things are moving along. We're a firm that was basically working in office for 40 years. I've been with Dimensional for 27 of those 40. And so really all we knew was in-office activity and in-office work. And as of March 11th last year, we moved everybody out. And so this question about how adaptable, how flexible can you be to a new environment, that came up in spades. And I think like most people in the industry, I think we've worked well through the quarantine period, and we're just now starting to get back to the office to some degree. I'm in the office today, and I've been in the office for the last couple of months. So we're seeing some normalcy, but I think there's a real recognition, just kind of the human nature around flexibility and adaptability. We saw it work really, really well through the past year, and we've functioned at a level or higher than we ever have. So the question now becomes, and I'm sure everybody on this Zoom call has the same question at their offices and within their firms, is what does the future look like, and what will we be doing in terms of in office or working from home? And for us, it's going to be a model, some kind of a hybrid model. We're big believers in community, but we also want to allow flexibility for our employees to balance their lifestyle with what they're doing here at the firm. So we will be probably around Labor Day here in the U.S., which is September 6th. We'll be moving into what we call a kind of a 3-2 hybrid model, three days in office, 2 days out, and then a lot of flexibility for managers to decide what kind of time they want their folks in the office or not. So we're getting there. We're getting back to normal. It's an exciting time to get to see people again and start to interact in the ways we used to.
Yeah, that's great. I mean, we get a sense now that there's potentially light at the end of the tunnel around the world, albeit at a different pace. Before we go back a long way back in time to talk about your earlier life and lessons and sport and financial services, maybe if we just go back to March 2020, because the whole thing was just such a surprise. And you've talked a lot about the human element, and I think it did take us all by surprise, the severity and the extent, the scope of this pandemic. But there's also, I mean, we're an investment manager, so we're interested in the market response as well. What lessons do you take away from that market response, the initial reaction, and then what's happened since?
Well, I and many of us have lived through many different markets. Markets that have gone up over time, and markets that have gone down, and they've done it in dramatic fashions, one way or the other. So part of our message in our story is always about discipline and about determining what sort of investment you do or don't want to make in the capital markets, and that can range from equity all the way to just putting your money in a money market fund. And there's a lot of decisions along the way. And then once those decisions are made, then there's a need for the ability to stay disciplined around what was decided as to how you would invest. So, the classic example is the markets go down in March, and then they race back up. You name the number, 90 to 110% over the last year. And of course, if somebody had gotten out of the market in March of last year and missed out on those returns, that makes it really, really difficult to get the long-term returns that we see for the equity markets, for example, for that 10 or 11% that we have seen over the last 100 years. So I would come back to the advisor part too. We work with financial advisors, independent advisors like Josh, that in essence, we provide the tools. We give advisory firms and their clients great access to the capital markets, efficient, tax efficient, cost efficient, diversified portfolios. And then there's a decision process there to decide how those portfolios are used, and a discipline process to make sure that the right risk profiling was done, people are in their seats. We all have fear and greed. That's the natural behavior for people. I get fearful in markets that go down. I get greedy when markets go up. So it doesn't matter who you are or how long you've been in the industry, you're still going to have that emotion. Now, the question is, how do you react to that emotion? And that determines a great investment experience versus a more mediocre investment experience. So, part of it again is great portfolios, but part of it also is the reaction to that. And as an old athlete, I think, I look at the advisors as really that coach and that counselor to just, focus people, keep them on track, keep them thinking the way they need to be able to access those capital markets returns over time.
Yeah, I think it's so true. I mean, the best investments in the world, if sold at the wrong time because of lack of discipline and acting on emotion, don't have the value to the end user. And I think that's why the power of advice is what it is. And the other takeaway is just the human resilience through this whole pandemic, the way that we've been able to respond and create vaccines out of nothing. And but markets, I think, end up being pretty resilient as well. They're pretty impressive.
Yeah, I think that's right. We have an advisor that we've worked with for a long time, and he had a great line. He says, we don't have people with investment problems. We have investments with people problems. So a lot of times it's that flip that really is the issue. And I think if people can, again, stay focused on their allocations, stay focused on what they're trying to do long term, and that takes discipline. People are going to be much better off. So that's an aspect of the behavioral part of finance that we all have recognized for many years. We've been doing this.
Yeah, exactly. If we now go back a little bit further in time, I mean, Tony mentioned in the introduction that obviously before your time in financial services, and particularly with Dimensional, where you've been for 27 years now, you had a storied career in athletics prior. Tell us a little bit about where you grew up and how you came to be a basketballer, and we can maybe touch on a few of the lessons that sport taught you that maybe you carried into your career.
Well, the great thing is the older you get, the better you get in your own mind, and the better people talk about how you played. So I appreciate those comments. I was a person that was pretty good at a sport, but I worked hard at it. And growing up, that was my passion, and it's something that allowed me to continue on with my college education. And then I got drafted by the Boston Celtics, as Josh mentioned, or maybe Tony mentioned that. And that was a great background for me. I think when you think about business and you think about life and kind of how people translate their activities and their work ethic into success, hopefully, a lot of it has to do with just hard work. And I've just taken that from sport, that if you can be a team player, if you can collaborate with people, and if you can work really hard. And I had a coach one time say to me, bring the result back better than I expected. So I'm going to put you on the basketball floor, and if I put you on the floor, I'm going to ask to trust you in doing something good for our team. Mm-hmm. And so they trust you with a little bit of time on the floor, and if you meet that expectation, they're going to put you back out on the floor for a little bit more time, and then you're going to get a little more, get a shot, and then you're going to get a rebound, and you're going to get more and more playing time and the accolades that come with it. So I think for me, it was one of those. Looking back at my career, I think the trust aspect is a big one, and I've translated that from sports into my working career, and I tried to work that way in my career is to if a manager or boss asked me to do something, I tried to do a little bit better than they had anticipated, and I see that happen with a lot of folks around our firm who do that. They meet expectations regularly, and that's something when young people ask, how do you get ahead? How do you do more? You don't have to wave your hand. You don't have to raise your hand to say, look at me. Just, produce better than somebody expected, and you do it over and over again. And that builds up this trustworthiness and this trust in you, and you'll get more and more opportunities. So I think for me, that's the golden rule of life and business and sports and everything else.
Yeah, I mean, there's a couple of great themes in there, really, isn't it? And we're going to come back to the idea of trust later in our time together. But trust just takes time to accumulate, doesn't it? It's not instant. I really like the analogy of the coach giving the player just a little bit of time on the court just to see what they do with it, and then maybe a little bit more next time. And then in the current, I think, environment, the world has moved a little bit more to me first instead of that team thinking. And it's helpful to remember just the power of collaboration, that idea that, if, together we know more. That's certainly our view of the markets. And I think there's no reason why we can't bring that into the team environment as well. Yeah,
and I think, one comment that I've always kind of stuck with me, I think it's about 10 years ago, I heard this from a fellow, or actually an MIT professor, Bob Merton, who was on our board and who obviously is a Nobel Prize winner. But Bob actually said one time, he said, trust equals competence plus trustworthiness. And I remember hearing him describe that in a way that he said, competence is all the things you bring to the table. It's your experience, it's your educational background, et cetera, et cetera. Trustworthiness then is again, meeting the expectations on a regular basis. and doing it over and over and over again. And the combination of those two then lead to this thing called trust. And that's where the kind of relationship builds up that you see, particularly in business, where you see people working together with a particular firm or person for many, many years, because that trust level is so high, because of that confidence, and then because of that trustworthiness and that regular activity, that habitual activity of meeting expectations.
Yeah, it's a clever way to think, isn't it? The idea of, competence and trustworthiness. If we do an inventory, all of us, of the people in our lives, chances are the people who are on our list are there for some combination of those two reasons. If we fast forward a little, you're in sport, you're a graduate of Berkeley, it's all going really well, you're drafted by the Celtics. Somehow you end up co-CEO of Dimensional Fund Advisors. What's the nexus? What happens in there that makes you take a kind of a change in direction?
I always tell people that there's a little bit of luck involved in every path or every journey that we're all on. And I love Josh's story because it was very similar to mine. I actually ended up hurting my leg. I was playing in Istanbul, Turkey, for a professional team there, and hurt my calf and Achilles. And I ended up moving away from basketball. I went back to school, finished up my MBA. And then I had gotten hired by one of the big investment banks in New York, and thought that was where I needed to be as an MBA. It had to be one of the big investment banks. And I think it was probably 3 years into it, I just recognized that it wasn't what I wanted to do. And I also, to parallel Josh's story, I had a stockbroker that was doing just that. That was transacting and selling me stock, and high commission and high turnover and all the things that weren't positive in my mind. So my experience was very, very poor. And one day I was on the desk in New York, and I opened the newspaper, the Wall Street Journal, and there's an ad in the bottom right-hand corner, it said money manager, Santa Monica, California. And at that time, I had decided that I was going to get out of finance completely, and I was going to go be a high school teacher and basketball coach in California. So I was mentally done with finance at that point in time.
Well, let me just interject there. Let me interject because, that's a pretty big statement. Like, you're so disillusioned with the financial services industry as it was presented to you at that time in New York that you figured, I'm going to do away with this entire profession and go and teach basketball in the other side of the country. What sort of things were you seeing that just made you uncomfortable?
Yeah, I just didn't see a way that, I always come back to my mother and, what would I need to do in finance to make my mother comfortable and confident in her investments in her retirement. And I just didn't see that. Again, the things that Josh mentioned and I'm mentioning now, the high transaction, the high cost, the turnover, all those things, the sales pitch around some new idea. We're going to look into the crystal ball, and I'm going to tell you what stock's going to go up and what stock's going to go down. And the more you're around that, the more you become aware that those abilities aren't there. That the market is really, really good at pricing securities, so that there's not a whole lot of ability for people to add value above and beyond the market. And those are those simple concepts that aren't really simple at first blush, but they are pretty simple when you hang around the story long enough. This idea that a market can price things better than an individual. And when you start to think about all the inputs in a market, it's investors and legal people and M&A people and investment bankers, and people are all looking at this stock, and they're moving that price around to reflect what the collective wisdom is of that stock. On average, that's a better estimate than you or I could guess or estimate on that particular stock. Now, will you and I win on occasion? Yes. And one of the experience I had coming out of my investment bank time period, I had been doing individual stock picking. I had a system that I used called CanSlim, which was, the C was for current earnings, and M was for momentum, and L was for leverage. And I would look all this stuff, and I'd put it into my spreadsheet, and I came up with stock selections. And I had actually I was 8-0 the last year I was at the investment bank. I'd won, or I'd gotten positive results in 8 stocks. And I loaded up, and I've told you this story, I loaded up on Boston Chicken, which was a chicken restaurant in the US. And I put it through my screen on Cancelim. It was a done deal. It was trading at 16. All the analysts said it was going to go to 24. I basically put almost my entire net worth. Again, an advisor would never suggest you put your entire net worth into a stock, but my stockbroker suggested that, and I with a lot of bravado, I agreed that was the right move because I was going to make a ton of money. And in those days, there was no internet or Bloomberg, so I was on a business trip in Utah, and I ran downstairs. I got the Wall Street Journal, went down the list, found Boston Chicken. Instead of 24, it said 8.
Oof.
And I thought, well, but for a moment, I thought there's actually a crease in the paper. So I thought maybe if I pull that crease apart, I'd find a 1 in there, and I'd only made $2 instead of 8. And it turned out there was no 1 in there crease. And I called my broker, and he said, well, he goes, it just didn't turn out the way we expected. I'm really sorry about that. And like Josh, it was just that I'm really sorry about that outcome. It was because we were guessing, trying to outguess the market. We guessed wrong. We put too much money into it. I lost it, basically almost 80% of my net worth on that one trade, I think. And that was a wake-up call. And so I fortunately went out to Santa Monica, and I went up to interview with Dimensional, David Booth, the founder that Josh mentioned, and Merton Miller, who was a Nobel Prize winner. They came out to the elevated area to greet me. I got to go out to lunch with Merton Miller, Nobel Prize winner and kind of one of the granddaddies of modern finance. And here I am, a 29-year-old rookie, potential employee, and he started laying out what he thought were the key capital market tenets that we all need to think about. And it seems so simple. He called diversification is your buddy. That's a simple one. He says costs matter, transaction costs matter. So he went through all these simple tenets, and I walked away from that lunch thinking to myself, that's different. And it's something I can get my head around if I really do some in-depth research. And then a gentleman named Dan Wheeler, who was the first advisor to use Dimensional, he also then sat me down and talked about independent advice and how independent advice and the expertise in the client space, coupled with Dimensional in the capital market expertise space, the combination of those two were really, really powerful. And that would be a new way that investment advice would be given in the US. Yep. And it wasn't like that. And as Josh mentioned, what I knew in New York wasn't like that. And I heard this story, and I thought to myself, boy, I could be in the financial services space and I could do something good. I could have a positive impact because I think the end result for clients would be positive. And I literally signed up that day. Dan took me to breakfast and said, let's start today. And I didn't know what my compensation would be. I didn't know what my role would be. And I just had, in life, I had one of those gut feelings, and I said, okay, let's do it. And that was 27 years ago.
I mean, it's pretty transformational, isn't it? You go from that experience, which was so soul crushing in New York, to taking this last experiment by seeing the small firm in California. But in that meeting, you're having lunch with a Nobel Prize winner who tells you all of the things that people should be taught about how markets function. And then, of course, you meet Dan, who's really kind of prophetic around the idea of these evidence-based principles of investing and financial advice and marrying those together. Dan had another wonderful saying that I can recall. It'll make you chuckle. Really about your Boston chicken experience, and hearing you tell that harrowing tale, you must almost have an allergy to chicken, based on what you went through. But Dan always used to say to groups of advisors, if you talk to clients about this sort of stuff, you'll be able to say, look, you can learn these lessons from us, or you can learn them from the market. But the market sends out really expensive tuition bills. That's always stuck with me because, as you say, it's the best processing machine we have for information, and that finds its way into prices. And actually, it kind of leads us neatly to, how did Dimensional get started as well? Like we're founded in 1981, but really it begins decades earlier with the academic community really starting that spark back in the 50s, really.
Yeah, it's a great story. I mean, in the 50s and 60s, as you point out, at the University of Chicago and some other academic institutions were looking at this question about market efficiency. And the question, one of the tests of market efficiency was, were there active managers, active stock pickers that could add value above what you would get from just a broadly diversified market portfolio? And as you know, and I know, and Josh knows, the answer was no, that the results of active professional stock pickers, there was no value added from that activity. So what David Booth and Mac McQuown, who's one of our board members currently still today, they were at Wells Fargo. They started the first index fund, S&P 500 index fund. Another founder, Rex Singfield, started the first S&P index fund for institutions at American National Bank in Chicago. So this is the mid 70s. So there was this test balloon around this idea of an index fund. And the whole concept of an index fund was if there wasn't value add from stock picking, and it looked like these professionals weren't adding value, then why not just hold the market, minimize your cost, diversify, keep your, the expense ratio low, and that would be a portfolio that would make some sense. Now, it wasn't that indexing caught on, immediately. We all know the story today where, the majority of all assets go into index type funds today. But that wasn't the case back in the 70s. And then in 1981, Dimensional started with what we call the first multi-factor investment fund, or a smart beta fund. And those are terms we hear now that seem to be new and current and exciting. But when you think about what Dimensional launched in 1981, the dimension was small cap stocks. So rather than just buying a market portfolio, Dimensional built out a small cap portfolio. And the research showed at the time, and still does, that small cap stocks outperform large cap stocks. So you didn't necessarily have to buy an index and agree to an average return. You could actually allocate a portfolio to small cap stocks and then eventually value stocks that would actually have a higher expected return than the market portfolio. And then where Dimensional really came in was the implementation part. And Dimensional allowed themselves some flexibility when buying and selling small cap stocks, so that there wasn't this rigid kind of nature to trading. We allowed, with 3,000 stocks in the portfolio, we allowed stocks to move above and beyond, just their index kind of a market cap, and allowed us some flexibility in terms of trading, so we didn't lose money on trading small cap stocks in the liquid market. So that flexibility was the kind of the value add, the implementation value add that really differentiated Dimensional in those days, and still does. You ask anybody around Dimensional, index funds are fine, but index funds, because of their rigid nature, lose some of what they propose to bring, because of those cost and trading issues that come with being rigid. And so Dimensional's flexibility allows us to be diversified, capture a certain area of the market, small cap stocks back in 1981, value stocks in the 90s, but then we add on this implementation aspect that adds value to the actual end result for the client. And if you look back at the microcap fund, which started in 1981, 40 years later, it's added, 160 basis points above and beyond, kind of a benchmark portfolio for small caps. So a lot of that has to do with allocation. A lot of that has to do with implementation and being flexible. So that's the Dimensional story in a nutshell. And it's been one that we've worked on, daily for 40 years. And we have as you guys know, a very, very long track record of being able to implement in a lot of different markets and do it in a very efficient way.
Yeah, I mean, I think it is an incredible story, because littered throughout those decades, the decades that Dimensional exist, and we're in our 40th year now, which is fantastic. It's a great thing to be celebrating. But even with the academic community before, it's a journey of quiet achievement, I think. I mean, we've had our own clients tell the financial advisors that we work with tell their clients, look, you may not have heard of Dimensional, but think of them as the biggest name you've never heard of. I mean, in reality now, we blush when we think about the fact that we're managing more than $650 billion US, and we're incredibly proud of that. But we've done that really without spending a penny on advertising. And I think it's because what we've quietly done is just implemented these firsts in finance. You know, the academics help us understand the answer to the question, where do returns come from? Dimensional's then about implementing those the greatest ideas in finance, like, as you say, smart size, value, profitability, and the way we can trade in, well, what I think is now 45 markets, developed and emerging day and night, without losing the integrity of that philosophy and those principles. So it's a story of firsts, but done kind of quietly. But there's a resilience in there, that's for sure. You know, if we think about Dimensional now, you know, you've been with the firm for 27 years. You joined it at a point when it was managing 10 billion US dollars, and now we're up to in excess of 650. Talk a little bit about the things that have stayed the same throughout that journey, that are key learnings for you and lessons, but also some of the things that have changed, happily.
Yeah, I think what I've loved about Dimensional my 27 years is there's a really high level of intellect and curiosity here. So, you know, you sometimes hear terms like the pursuit of truth, or, you know, you mentioned this interest in getting to the right answer. And that truly is it. I mean, David Booth has laid down a foundation around that, around, you know, we always say doing the right thing for the client. You know, would this be good for the end client? It's never the question about would this sell. It's is this good for the client? Does the academic research support it? Can we implement it in a way that's going to be additive and unique in the industry? And so I think that's been what has been the hallmark of Dimensional over the many years. I think, you know, there's an innovation aspect to Dimensional as a firm. And I think you mentioned size and value and profitability. And as you know, we just launched a set of ETFs that are active ETFs. So we're not doing index ETFs, we're doing active ETFs that are allowed because of the 2019 ETF rule that allows customized baskets. So in the ETF space, you know, we're literally the first ones that are doing active ETFs that we think, again, adds value above and beyond an index type of solution. So, you know, the innovation has never changed. I think the orientation around, you know, what's the right answer, what's the, you know, the best answer for a client, that's never changed. And that's something that, you know, for me to be around 27 years, I got to be engaged and feel like I'm doing something that's a positive for the end client. And that's probably what I'm most proud of, I think, at Dimensional. And certainly things have changed, as we mentioned. You know, Josh and I's experience for clients was vastly different than what it was today. So it was great for the stockbroker back 25 years ago. A lot of transactions, a lot of commissions, a lot of, you know, pitches of various stories of this stock or that stock or this market movement. You know, again, the orientation was around turnover, and the more activity I can get as a broker, the more money I'm going to make. You know, what we look at now, and I'm looking, you know, at Josh and team like at MASECO. I mean, you know, we have, it's low cost, it's diversified, it's asset allocated, it's wealth management to a very high level that includes tax and charitable giving and estate planning. So the outcome for the client, you know, when I look at the 25, 30 years I've been involved in this space, what's being delivered to clients and what the idea of the value add of a profession of advice is has just, you know, exponentially gotten better for the end client. So if we've had a little impact on that, or I personally have had a little impact on that, I think, you know, I'm proud of that, and I'm proud of that change over time over the last 25 years. It's much, much better for the clients. You know, folks on the line that are watching that are clients, you're way better off than I was 25 years ago, or 30 years ago, whatever it was, as a client back in the old kind of the brokerage space. So that makes me very pleased.
Yeah, I think it's almost, despite our size, we've had this kind of cultural consistency about looking after people and doing the right thing, and it's just been rock solid through the whole journey, from small assets to very large assets, and it extends to the work that we try and do in making investing simpler and more understandable and more accessible. And in fact, we've had a question that's come in on that from one of the attendees on today's session, and we'll come to that shortly. But you know, just on leadership, because part of what we wanted to cover today was on leadership, and you know, just how you keep it fresh. it's a conversation you and I have often had about this idea of entrepreneur to enterprise. And just tell us a little bit more about that in your thinking as co-CEO.
Yeah, I think a lot of the people on the line probably have been involved in those situations or seen this in their own firm. It's this classic struggle between the flexibility and the looseness of an entrepreneurial environment where people are creating and they're imagining and they're doing their own thing and they're independent. And then as you progress to a certain size, it becomes what I call an enterprise, which then says you've got to control things a little bit more. You got to be less flexible. And I think the challenge for all growing firms is to try to figure out how do you maintain the entrepreneurial spirit within an enterprise type of a firm. And that's a daily challenge, but it just goes to all the simple aspects of, I'm a macro manager. I like to delegate. I like to push to people. I like to have them run, again, competent people. And I usually have trust in them because they've met my expectations multiple times. And once they do that, I like to stay out of their way, because I think you get a lot more from people when you give them that ability to be an entrepreneur, to be independent, to make the decision themselves. The only environment I've ever feel like I haven't enjoyed or not thrived in is when that manager or that boss, has me go out and do something. I bring it back and they say, well, that's great, but we're going to do it this way. And that's a bad outcome. So I daily, I walk in, I try to tell myself, I'm not going to do that. Now, are there going to be mistakes, from people? Absolutely. But I think you also have to then corral the mistakes and make sure that, if there's a mistake that happens, you're going to expect it. And that's okay because somebody's, trying, but it's not going to make or break the entity or the enterprise. I think that's an awareness you have to have as a leader. So I think culturally, you want to have a recognition of a mission. And I think I've probably said that a few times today. Our mission has been, it's about the client and supporting the advisor to give the client great solutions. And you got to feel good about that. There's got to be energy around that. Same with a sports team. You got to have a goal and a mission and a something for people to corral around and get energized by. And then it just becomes a set of daily habits that are in support of that broader goal. And sometimes it doesn't sound that exciting, but it's can you walk in on a daily basis? Can you deliver excellence? Can you work hard at something? Can you collaborate well? Can you be respectful to others? Can you listen? A lot of times we forget the easy concept of listening, and we all have that issue. So you start every conversation with, I'm going to listen to you, Dave. I'm not going to talk and tell you where I'm going or what I'm doing. But a lot of those things are habits. You just got to get yourself into that mode. So leaders have to listen. Leaders have to take in all kinds of input. There are moments when leaders will have to make the call after they get the input that they need. And then they also have to be respected enough, hopefully, to go back out to the people that might not have agreed with that call and have them be supportive of that direction, that call. So again, a lot of it wraps around this whole idea of trust, and you got to have confidence, and then you got to have keep meeting expectations. And if you do that, then you're going to have a team that wins quite a bit. And I think that's how you build culture.
Yep. It's in some ways summed up by that great quote by Walt Disney's brother, Roy, who said, if your values are clear, your decisions are easy. We keep coming back to this idea, both with your history and dimensionals around values and mission. And it's great to have a job, but it's better to have a calling. And if you've got those sort of things working in your favor, then that's got to help you as a leader. It's got to help your teams as well.
For sure.
We're going to just pivot now to answer some questions that have come in on the Q&A. And the first of those, I think, is very, very topical, which is, just what's dimensional thinking around cryptocurrencies? What are we doing these things? They're obviously out there in the news. There's a lot of noise about them, a lot of interest in them, and it's a huge market. But what are we doing with that, and what's our thinking around it?
Well, I think like everything with dimensional, we take a methodical approach at reviewing, the investment aspects of any investment, whether it's cryptocurrency or something new in the equity markets or the fixed income markets. So there's a lot of focus and obviously that question is reflective of that. We're in the middle of looking at what it is or isn't. I don't know if Dimensional has a view as to, hey, cryptocurrency has become something that everybody talks about, is aware of, so we're going to come out with a cryptocurrency fund. That's not what we do. I think we'll look at it like we always do, and we'll make a determination whether and how cryptocurrency fits into a portfolio, and if it's of interest from a research and academic perspective, then we would continue to think about it. But if it's not, then it's an area of the market that we probably wouldn't participate in.
Yeah, I think it's a fair statement of the way we've approached things like this in the past. It's got to meet a certain academic standard before we can genuinely become interested in it. It feels like we're a long way from that point at this stage.
Yeah, but a fair question is asked. My daughter, who's 16, asked me about cryptocurrency last night at the dinner table. So
yeah,
it's a topical moment for cryptocurrency and what it means to not only as an investment, but then what does it mean to our world and kind of how we conduct business. So I think it's a great one to continue to think about.
I think so too, and maybe some of the technologies that underpin the cryptocurrencies, things like blockchain, could inadvertently end up being beneficial to all sorts of companies, public and private. Like so many other investment topics, it's not necessarily the headline that's the answer, but maybe some of the things that underpin it. So we'll see, I guess.
Yeah.
Now, Dave, without straying into the area of advice, and in fact, we have had one question here that I think is probably best going to be answered by Josh, and we'll take it offline because it's really quite specific, but Josh will be all over it. But there's another one that's come in, and we don't want to stray into advice here, but the question is literally, what percentage of my portfolio should be in ETFs? And what are we thinking around that as a delivery vehicle relative to some of the other things that maybe people could hold in portfolios?
Yeah, well, we like all of them. So we start with a dimensional capital market approach, our implementation building, and then we say, are there different vehicles that can house Dimensional's approach, investment approach? And the answer is yes. So historically, we just offered mutual funds. And as you and Josh know, we started offering ETFs just last year. And as I mentioned, the idea of ETFs was that we could take advantage of this custom basket rule and be able to deliver an actively managed ETF that was aligned from an implementation perspective with what we've been doing on the fund side. So ETFs are just a vehicle. I mean, it's a lot of it has to do with the platform you're buying on. There's different transaction costs, for instance, on an ETF versus a mutual fund. Might be higher, might be lower. There's some tax differences, and that's probably one where Josh can explain that really well in terms of how dividends are processed. Unrealized capital gains in a fund versus an ETF. That's probably the biggest advantage that people will focus in on, and the most obvious and easy one. But we have tax managed funds that we've managed for 15 years that are on par from a return perspective and a tax efficiency perspective with ETFs. And now that we have active ETFs, we think those active ETFs are going to actually even add more value above and beyond an index ETF. So in my mind, it's really about this specialization and customization of the client's portfolio and outcome. And I think what you'll see going forward probably is even greater focus as well on separately managed accounts. That's another area that frankly people are starting to think about with concerns around ESG, sustainability, environmental, that sort of thing, or concentrated stock positions, or the things that MASECO does with tax loss harvesting and charitable giving. The more flexibility you have in your portfolio, and that could be vis-a-vis a mutual fund or an ETF or an SMA, that flexibility is value. As Myron Scholes, who's another board member and a Nobel Prize winner, and won his Nobel Prize for the Black-Scholes option model. Options are valuable. So the options that you have out there are good. And again, the options are varied enough and wide enough, and there's enough attachments from a tax and a cost perspective that going back to the advisor's role, that they're best suited for a individual client. My mom or your father are different, and it's great to have an advisor look at the tool set, the toolbox, and make those decisions as to what sets of funds or ETFs or SMAs are going to be the appropriate mix for a particular client. So a long answer to a probably what was thought to be a simple question, but it's complex, it's varied, but it's an important question that, again, advisors are super helpful with in terms of deciding that for a client.
Well, I think it's a great answer, and it actually leads us probably into the last question we've got time for today. And it was asked a little earlier in our session, and felt right to just maybe use it as the way we close out our time together today before we hand back to Tony. And it's really around this idea of potentially the power of advice, because the question reads, given that index funds and other weighted funds that are still passive are, as we've explained, relatively simple in nature. You buy and hold them rather than needing to try and pick the tops and bottoms of the markets as long-term discipline. Why do we place such an emphasis on working with financial advisors, and have we not been tempted to go directly to consumers like other investment managers?
Well, I'll start with the simple fact that, and I know you have an advisor as well. I have an advisor. People always ask me that. You've been in finance for 30 years, and you know all this stuff about investing. Why would you need an advisor? And there's a bunch of reasons for that. I mean, one, which we just described, was, there's a behavioral aspect. It's nice to, I'm a busy person. It's nice to run investment ideas off my advisor, and my advisor has an opinion that may be more informed or less informed, but it's a different view than I have. And it's good to backstop those types of questions. Number two is I've got 4 kids and a wife, and kids in college and high school, and we do different charitable stuff, and we have tax situations, and it's great to have somebody who works on all that for me. And the third one I heard, which I think resonated for me, I was in London probably 10 years ago, and David Jones, who you worked with in our office there in London, he said, one of the things about advisors, there's a phone number that I can hand my wife. So God forbid I'm not around. My wife and my kids, in my mind, are very well taken care of, because they have a phone number, and that's my advisor who knows my story, my life, my investment situation intimately. And if I wasn't here to participate in that for whatever reason, my wife has a phone number and she can make that call. So I'd be very confident about the extension of what we currently have. And then when you talk about generational issues with my kids and how potentially they get involved in wealth management and in our personal family situation, my advisor knows them, and he continues to have conversations with them. And so it's a comforting thing, I think, to have an advisor. And look, I'm more than happy to pay my advisor what I pay him to take, in essence, to take that off my plate, take that worry off my plate, take the detail off my plate, have a confidant that I can talk to about anything in my life, financial or personal, and have a great back and forth. It's a hugely valuable deal. So when people ask, why would you guys work with advisors and not with the retail public, I think it's a really deep question. But again, what I saw 27 years ago was that this independent advisor who's working on behalf of the client, i.e. me, and acts as a fiduciary to my best interest, that's somebody who I want to have working with me on my team. And we've seen that outcome for clients, be so positive for these last 30 years that it's hard for us to actually walk away or try to move away from not being involved with financial advisors. It's a part of the equation, the great client experience equation that has to be there. And I just can't imagine a situation where there's just funds out there and you're going to get the same kind of outcome that you get working with an advisor.
Yeah, exactly. Well, Dave, we're hard up upon time here, and for those questions that we've not been able to get to, we apologize, and maybe it'll be possible for Josh to go back on some of the more specific ones. But Dave, we just want to say thank you very much for spending this time together. It's been great to speak to you, as it always is. I guess we'll hand back to Tony to close our event today.
Thanks, Dave. Thanks, everybody. Appreciate the time.
A big thank you to Dave and David and Dimensional. Thanks very much. Something that resonated well with me was it's just wonderful to hear about people's personal journey and career journey, if you will. So thanks for that. And so much that we learned there, very interesting. And we really appreciate both the time you've taken, busy people, and also for sharing your insight. So thanks very much. And thank you very much for everyone who attended as well. Have a good evening or good afternoon, whichever time zone you're in. Thanks very much.